This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Welcome back to another edition of the Wise Investor Show podcast, where me and my colleagues at the Wise Investor Group help you make informed financial decisions that build wealth and protect your future. I'm your host, Matt Anderson, and today we're diving into a topic that's often misunderstood but can have major financial consequences. MAGI, Modified Adjusted Gross Income. Now, MAGI isn't just a tax term, it's the gatekeeper to deductions, credits, surcharges, and subsidies. Misjudging your MAGI can cost you thousands in lost benefits or surprise expenses. In addition, the definition of modified adjusted gross income is different depending on what deduction, credit, or subsidy we're talking about. Only Congress could come up with something so ridiculous. So today, we're breaking down some of the costliest MAGI pitfalls and giving you some smart strategies to consider to keep your income in check. Now, before we get started, we are getting into some tax information here. I just want to make clear that this is not meant to be tax advice or recommendations. I don't know your particular situation, so please, before implementing any of the strategies or things that we're talking about here today, please consult with your financial professional and your tax professional. All right, well, let's get into it. So the first pitfall is the SALT deduction phase-out. Starting in 2025, the state and local tax deduction cap has been raised to $40,000. Sounds great, right? But here's the catch. If your MAGI exceeds $500,000, the deduction starts to phase out, reduced by 30% of the excess income. Important to note that no matter how high your income goes, you'll never get less than the old $10,000 SALT cap. Now here's an example. Let's say your MAGI is $540,000. That's $40,000 over the $500,000 phase-out threshold. Now 30% of that excess is $12,000. So instead of getting the full $40,000 SALT deduction, you'd only get $28,000. Now that's still better than the old $10,000 cap, but you've lost $12,000 in deductions just by crossing the threshold. MAGI for the SALT deduction is calculated by adding back any excluded foreign income to your adjusted gross income. So if you're in a high tax state and your MAGI creeps past that threshold, you could potentially lose tens of thousands in deductions. Also new in 2025 is the Enhanced Senior Deduction. If you're 65 or older, you may qualify for a $6,000 deduction per person. But this benefit starts to fade once your MAGI hits $75,000 for singles or $150,000 for joint filers. It's fully phased out at $175,000 and $250,000 respectively, with a 6% reduction rate on the excess. Here's an example of how it works. Imagine a retired couple, both age 65, filing jointly with a MAGI of $200,000. That's $50,000 over the $150,000 phase-out threshold. At a 6% reduction rate, they lose $3,000 of their potential $12,000 deduction. So instead of the full $12,000, they only get $9,000, a meaningful reduction just for being over the limit. This means even moderate income seniors could lose out if they're not careful with income planning. MAGI for the purposes of the Enhanced Senior Deduction is the same as for the SALT deduction. It's your AGI, your adjusted gross income, plus excluded foreign income. Now let's talk about Medicare IRMAA, which stands for Income-Related Monthly Adjustment Amount. It's basically a surcharge added to your Medicare Part B and Part D premiums if your income is above certain thresholds. And here's the thing. MAGI for purposes of Medicare IRMAA includes your adjusted gross income, plus any tax-exempt interest income, like interest from municipal bonds. So even if you think your income is moderate, that muni bond interest from your portfolio could push you into a higher IRMAA bracket. For 2025, the standard Medicare Part B premium is around $185 a month, but if your MAGI is above $106,000 for single filers or $212,000 for joint filers, you start to pay more. And it scales up quickly. At the top tier, premiums can hit $628.90 a month per person. Now, if you buy health insurance through the ACA marketplace, also known as Obamacare, your eligibility for premium tax credits depends on your MAGI relative to the federal poverty level. And here's the kicker. Go even $1 over and you could lose thousands in subsidies. Now, MAGI here includes adjusted gross income, tax-exempt interest, and untaxed Social Security benefits. So it's easy to miscalculate this. This is an especially important issue in our area or any other high standard of living area where insurance premiums are high. Clients who would normally pay $1,400 a month for health care might only pay $100 a month because they effectively manage their income. Now, before we wrap up this section on MAGI-related pitfalls, I want to sneak in one more that's not technically tied to MAGI, but it's still incredibly important and often misunderstood. This one's based on taxable income, not modified adjusted gross income, but it can have just as big of an impact on your bottom line. And I'm talking about the qualified business income deduction, or QBI. If you're a business owner, freelancer, or professional in a pass-through entity, like an S-corp, a partnership, or a sole proprietorship, for example, you may qualify for the QBI deduction, which can knock off up to 20% of your qualified business income. But here's the catch. If you're in a specified service, trade, or business, what's called an SSTB, and here you just want to think about financial services, law, consulting, health, or other similar fields, your eligibility starts to phase out once your taxable income hits a certain level. For 2025, that phase-out begins at $197,300 for single filers and $394,600 for married filing jointly, and ends at $247,300 and $494,600 respectively. The top limit increases $50,000 in 2026 for joint filers up to $544,600, so a pretty meaningful increase there. If your taxable income falls within that range, then your deduction gets reduced. If you're over the top end, you lose it entirely. So here's an example. Imagine a business owner who's a consultant with taxable income just over the phase-out threshold. Because of that, she lost her entire QBI deduction, nearly $40,000. And the worst part, she didn't even realize it until after the return was completed. So while QBI isn't MAGI-based, it's still a critical piece of the puzzle. If you're in an SSTB and your taxable income is creeping up, it may be worth looking at strategies to bring it down. Things like retirement contributions, charitable giving, or just timing of recognizing the income. Once again, this isn't meant to be tax advice, so please talk with your tax professional before taking advantage of any of these. Now, we've covered the landmines, so let's talk about how to avoid them. Here are some strategies to proactively manage your modified adjusted gross income. Tax loss harvesting is a powerful year-end strategy that involves selling investments that have declined in value in order to offset other capital gains. This can reduce your taxable income and, more importantly, your modified adjusted gross income. Now, let me share an example. During a year-end review, your advisor notices that your MAGI is estimated to be $1,000 above one of the Medicare IRMAA thresholds. That means you're about to move into a higher premium bracket, costing an extra $1,500 per year in Medicare premiums. So you dig into your portfolio and find a position with a $3,000 unrealized loss. Now, it's a single-digit percentage decline, and maybe under normal circumstances, you might not sell it. But because you do the analysis, you realize that realizing that loss would bring your MAGI below the IRMAA threshold. So you sell the position, harvesting the loss, and save $1,500 annually. It's a great example of how proactive tax planning can pay off. Also, don't forget about mutual fund capital gains distributions, which often occur late in the year, typically in November or December. These can unexpectedly inflate your MAGI if you're not watching closely. Even if you didn't sell anything, you could still be hit with taxable gains from fund activity. So bottom line, tax loss harvesting isn't just about reducing taxes. It's about managing your MAGI strategically to avoid costly phase-outs and surcharges. A little planning can go a long way. Once again, that planning should be done with a tax professional. Now let's talk about one of my favorite strategies for retirees, and that's qualified charitable distributions, or QCDs. So if you're over 70 and a half, this is a game changer for managing your income and giving back at the same time. Here's how it works. You can donate up to $108,000 directly from your traditional IRA to a qualified charity. That donation counts towards your required minimum distribution. But, and this is the key, it doesn't count toward your MAGI. And why is that powerful? Because most charitable giving, whether it's cash or appreciated securities, it still shows up in your income. You might get a deduction, but your modified adjusted gross income doesn't go down. With a QCD, the income never hits your tax return. It's like it bypasses your MAGI entirely. This is especially helpful for folks who don't itemize. If you're taking the standard deduction, your charitable giving normally doesn't give you any tax benefit. But with a QCD, you may get the benefit even if you don't itemize. So let me give you an example. A client, age 73, with $40,000 RMD. If they took that entire distribution, it would push their MAGI over the Medicare IRMAA threshold, bumping their premiums up significantly. Instead, the client donates $5,000 of their $40,000 RMD to a few of their favorite charities through QCDs. They satisfy their RMD, support causes they care about, and avoid the IRMAA surcharge entirely. That's just smart giving. Now, a few things to remember. The QCD has to go directly from your IRA to the charity. You can't take the money out and then donate it. It has to be a direct transfer. And it only works with traditional IRAs, not 401ks. Bottom line, if you're retired, charitable, and looking to keep your MAGI in check, QCDs may be one of the most efficient tools out there. All right, let's talk about one of the simplest and most effective ways to reduce your MAGI, which is pre-tax retirement contributions. Whether you're still working or self-employed, contributing to retirement accounts like a 401k, traditional IRA, or even a SEP or simple IRA can make a big difference. These contributions are what we call above-the-line deductions, which means they reduce your adjusted gross income and, by extension, your modified adjusted gross income. For 2025, you can contribute up to $23,500 to your 401k, and if you're 50 or older, you get an extra $7,500 catch-up. That's $31,000 you could shield from income and MAGI. Traditional IRAs may be another great option. You can contribute up to $7,500, and again, there's a $1,000 catch-up if you're 50 plus. Just keep in mind that whether it's deductible depends on your income and whether you or your spouse are covered by a workplace plan. Now, if you're self-employed, you've even got more flexibility. SEP IRAs let you contribute up to 25% of your compensation with a cap of $69,000 for 2025. Individual 401ks may even be better for lower income business owners since you get the $31,000 salary deferral with no compensation caps. Plus, you can add profit sharing on top of that. Simple IRAs are also an option, especially for small business owners. So here's why this all matters. Let's say that you're right on the edge of a phase out, maybe for the QBI deduction or Medicare IRMAA. By maxing out your retirement contributions, you may be able to drop below that threshold and preserve a valuable deduction or avoid a costly surcharge. And it's not just about taxes. You're also building your retirement nest egg while keeping your current year income in check. It's a win-win. If you're not maxing out your pre-tax retirement contributions, you may be leaving both tax savings and long-term growth on the table. Now, I do want to add a caveat here. Maxing out your pre-tax retirement contributions may not be the best strategy for everyone. You want to be careful of having most of your retirement nest egg in pre-tax retirement accounts. The IRS will get their cut when you start distributing money from the plan, whether voluntarily or due to required minimum distributions. If this is your only source of funds in retirement, you lose flexibility and leave yourself at the mercy of future tax rates, which could be higher than tax rates are now. If you don't have Roth accounts or after-tax investment accounts, it may be wiser to focus on building those up, even if it means forfeiting the upfront tax deduction today. Now let's talk about health savings accounts, or HSAs, one of the most underrated tools for managing your MAGI and building long-term wealth. If you're enrolled in a high-deductible health plan, you can contribute to an HSA and get a triple tax benefit. Your contributions are tax-deductible, the money grows tax-free, and withdrawals for qualified medical expenses are also tax-free. Now for 2025, the contribution limits are $4,300 for individuals and $8,550 for families. If you're 55 or older, you can tack on an extra $1,000 as a catch-up contribution. Now here's the MAGI angle. HSA contributions are above-the-line deductions. That means they reduce your adjusted gross income, which directly lowers your MAGI. So if you're close to a phase-out threshold, whether it's for a deduction, a credit, or something like a Medicare IRMAA, an HSA contribution could be the difference between qualifying and missing out. And here's the kicker. You don't have to spend the money right away. You can let it grow and reimburse yourself years later. So it's not just a tax tool, it's also a stealth retirement account for healthcare. Bottom line, if you're eligible for an HSA and not using it, you may be missing out on one of the most efficient ways to reduce your MAGI and save for future medical costs. Now let's talk about something that can sneak up on you. Large one-time income events. These may be things like Roth conversions, selling a business or rental property, exercising stock options, or even getting a big year-end bonus. Now, these events aren't inherently bad. In fact, they're often part of a smart financial strategy. But here's the catch. They can push your MAGI over key thresholds, triggering phase-outs, surcharges, or causing you to lose valuable benefits like the QBI deduction, ACA subsidies, or even bumping up your Medicare premiums. And here's where a lot of people make a mistake. They only look at how the event affects their tax bracket. They say, well, I'm still in the 24% bracket, so I'm fine. But what they miss is the domino effect. That one income event could push you over multiple MAGI thresholds, impacting deductions, credits, and even things like IRMAA surcharges. For example, clients could do a large Roth conversion and without realizing it, bump their MAGI just enough to lose a deduction or trigger a higher Medicare premium. That's thousands of dollars in unexpected costs, all because they didn't look beyond the tax bracket. So what's the strategy here? Timing and spreading. If you're planning a Roth conversion, maybe break it into chunks over a few years. If you're selling appreciated assets, consider doing it in a year when your income is lower, or offset the gain with losses elsewhere in your portfolio. Bottom line, before you make a big financial move, take a step back and look at the full picture. A little proactive planning can save you thousands of dollars in taxes and surcharges and keep your MAGI right where you want it to be. Once again, talk to your advisor and tax professional early to formulate a strategy. All right, I'm going to take a little break here, and when we come back, we will get right back into it. Thank you. You're listening to the Wise Investor Show podcast.
The Magnificent Seven have become the Lagnificent Seven. The clear leaders of the past 2 years are now bringing up the rear. Is this just a correction or something worse? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show podcast. I'm Matt Anderson with the Wise Investor Group, and before the break, we were talking about modified adjusted gross income pitfalls and how they can potentially key thresholds and trigger phase-outs, surcharges, or cause you to lose valuable benefits like the QBI deduction or ACA subsidies, or even bump up your Medicare premiums. Here, we're going to shift a little bit, but before I do, just want to let you know we are talking about some different tax strategies here during this podcast. This podcast is not meant to be tax advice nor recommendations. So before implementing anything that you hear on this podcast today, please talk with your financial advisor or your tax professional. All right, so we were talking about modified adjusted gross income, how to reduce it, why it matters, and what it affects. But here's something important to understand. Not all deductions lower modified adjusted gross income. Some strategies only reduce your taxable income. And while they won't help you avoid phase-outs or surcharges tied to MAGI, they can still save you a ton, especially when it comes to capital gains taxes. Let me explain. Capital gains, especially long-term capital gains, are taxed at preferential rates. 0%, 15%, and 20%. And which rate you pay depends on your taxable income, not your modified adjusted gross income. In 2025, here are the thresholds. For single filers, the 0% rate goes up to $48,350 of taxable income. The 15% rate goes from $48,351 up to $533,400, and the 20% rate is over $533,400. Now, for married filing jointly, the 0% rate goes all the way up to $96,700 of taxable income. And remember, taxable income is after deductions. 15% rate is $96,701 of taxable income to $600,050, and the 20% rate is over $600,050 of taxable income. So even if your MAGI is high and you're phased out of certain deductions, lowering your taxable income could mean the difference between paying 15% or 0% on your capital gains. This is where below-the-line deductions come into play. These don't affect MAGI, but they do reduce taxable income. So some examples include charitable contributions, mortgage interest, state and local taxes up to the cap, medical expenses if they exceed 7.5% of your adjusted gross income. Now let's focus on charitable giving because I think that's where you can really get strategic. If you normally take the standard deduction, your charitable gifts may not give you any tax benefit at all. But by using a bunching strategy, you can group multiple years' worth of donations into a single tax year, enough to potentially push you over the standard deduction and allow you to itemize. Even better, consider donating to a donor-advised fund. You get the deduction up front, but you can distribute the funds to charities over time. It's flexible, efficient, and it's great for tax planning. Now here's an example. Imagine a couple who typically gives about $10,000 a year to charity and takes the standard deduction. But in a year when they have a large capital gain, they decide to bunch 3 years' worth of donations, $30,000, into 1 year and contribute to a donor-advised fund. That allows them to itemize and lowers their taxable income enough to drop a good chunk of their capital gains from the 15% tax bracket into the 0% tax bracket, potentially saving them thousands of dollars. And they still are able to distribute the $10,000 a year that they always did out of the donor advised fund to their charity for the next 3 years. Even if a deduction doesn't lower your MAGI, it can still be incredibly valuable, especially when capital gains are involved. Lowering taxable income can unlock major savings, so don't overlook these opportunities. Talk to your advisor and your tax professional before year end. And here's a little secret that most people, and even some professionals, overlook. Your choice to itemize or take the standard deduction on your federal return affects your state return also. In states like Virginia and Maryland, if you take the standard deduction federally, you're required to take the standard deduction on your state tax return as well. And here's the kicker. The state standard deduction is usually much lower than the federal one. For example, in Maryland, the 2025 standard deduction is only $6,700 for joint filers. But if you itemize, you may be able to deduct far more. This is where charitable bunching can really shine. There have been cases where even a relatively modest charitable gift could allow someone to itemize, and the state tax savings alone nearly pay for the donation. Let's look at an example. Let's say there's someone who has $30,000 of itemized deductions. Well, the federal standard deduction this year is $31,500, so that person probably wouldn't itemize on their federal return. And they would take the $6,700 standard deduction on their Maryland return. But if they upped the charitable giving by just $1,500, they would itemize on their federal return, and their Maryland deduction could be as much as $24,800 higher. This could be close to a $2,000 Maryland state tax savings, which, as you see, might be more than the amount that the client gave to charity in the first place. So far, we've talked a lot about how to reduce modified adjusted gross income, and for good reason. Helps you avoid phase-out surcharges and keeps more money in your pocket. But here's something that might surprise you. Sometimes it makes sense to increase your modified adjusted gross income. I know that sounds counterintuitive, but hear me out. This is especially true when we're doing forward-looking planning. So if you're already phased out of all the major benefits like the SALT deduction, the QBI deduction, or the Senior Enhanced Deduction, then recognizing more income now might actually set you up for greater tax savings in future years. Let me give you an example. Let's say a person has a large inherited IRA, and he's been spreading the distributions over 10 years to avoid a big tax hit in any one year. Sounds like a smart move, right? Well, after taking a closer look, he realizes that the distributions were bumping his modified adjusted gross income just high enough to completely phase out his QBI deduction and lose an additional $30,000 in SALT deductions. All in all, he may be losing close to $70,000 in deductions every year. So he and his tax professional run the numbers. And even though taking a larger IRA distribution this year would push him into a higher tax bracket, the tax savings he'd gain over the next several years by reclaiming those deductions might far outweigh the extra tax he'd pay this year. It's a classic case of short-term pain for long-term gain. And it may only happen because he took the time to analyze his MAGI and look beyond just the current year. And that's the key takeaway. Sometimes increasing your MAGI is the right move, but only if you've done the math and looked at the full picture. This is where working with a financial advisor and a tax professional really pays off. You do not want to make these decisions in a vacuum. All right, let's wrap this up. We've covered a lot today, from the hidden traps of MAGI to the smart strategies that can help you avoid phase-outs, surcharges, and missed opportunities. And we didn't stop there. We also looked at strategies that don't affect MAGI but still lower your taxable income, which can be a huge win when it comes to capital gains taxes. But we also talked about something that's just as important, knowing when it actually makes sense to increase your modified adjusted gross income. That's right. Sometimes recognizing more income now can unlock bigger tax savings later. So what's the big takeaway? MAGI planning isn't just about taxes, it's about strategy. It's about looking at the full picture, running the numbers, and making decisions that align with your long-term goals. And it's not something you want to do alone. Work with your financial advisor and consult your tax professional, and do it before year end while you still have time to make adjustments. Well, that's it for me. I wish you all a wonderful fall season, and as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.